So I'll quickly run through some key points about what's going on in Asia and then leave time at the end for Q&A. So I guess the first point, as Lisa said in the introduction, is I'll talk about performance. So I am pleased with performance. In terms of absolute, in the last year, we're up over 14%, and over the same time, the ASX is down over 7%. So, for those of your investors that are your clients that are in Ellerston Asia, the asset allocation decision to go to Asia has definitely been the right one. And then within Asia, our fund has outperformed the benchmark by almost 600 basis points in the last year. So I'm pleased about that. It has been a very up and down sort of year with COVID and a lot of other things that have happened, particularly in China. But we've managed to navigate that quite well and expect to be able to do that going forward in the future. The other thing I'll mention is that the NTA is up around 120. It's around 130 as of yesterday, and we have closed the discount from where it was during the height of COVID. Lastly, some news is that Ellerston Asia has been named a responsible investment by RIA. So we are the first emerging markets or Asia fund in Australia to get this certification. And as many of you know, ESG is a very important part of our investment process, and it's nice to have that certification, that recognition from an outside source. So I'll move on to the dividend. Thank you to some of the Morgans network. When we first started paying a dividend back in 2018, we sort of did a survey of what investors wanted, and Morgans was sort of part of that analysis. And the feedback that came back is that people want a sustainable dividend that is growing over time if possible. And so we waited for quite a few years to pay the initial dividend, and the reason was we wanted a dividend profit reserve that could sustain 2 or 3 years worth of that dividend payout. There are other LICs, as I'm sure you know, even other Asian LICs, that they'll pay out 6 cents one year and then 1 cent the next year and 12 cents. It's all over the place, and that is not the sort of dividend policy we want. We want it to be consistent for investors to know what they're going to get. So that said, we did realize a lot of gains in the last year and in the last 2 years. So we have upped the dividend quite significantly. The last dividend was 2.5 cents, which is a 67% increase on interim. And then you can see in that last bullet point there, even with the payout of that dividend, there's still around 7.5 cents left in roughly profit reserve. So, we are confident that we can continue to pay out the dividend that investors expect. Okay, I'll just spend a little bit of time on sort of the asset allocation decision and whether investors should be in emerging markets versus developed markets. And then, it's our long-standing view that Asia is by far the best part of emerging markets. So one thing that I feel very, very strongly that emerging markets is going to outperform developed markets over the next 2 to 5 years. And there's 2 reasons for that. One is, as you know, Ellerston Asia is a growth fund. And we have thought for many years that Asia is the best growth story in the world. And I think that COVID has really sort of accelerated that, because now you have most developed markets are at or near the zero bound of interest rates. Fiscal policy has blown out in almost every developed market. And so that sort of Japanification of DM has really accelerated because of COVID. And as a result, there is basically no structural growth left outside of the technology sector in a lot of developed markets. And emerging markets, on the other hand, are structural growth stories. So the demographics, the technological leapfrogging, infrastructure build, capital market liberalization, a lot of those things, they are still on track. They did not get derailed at all by COVID. And so I think that once investors realize that the only place they're going to get structural growth is in EM, that differential between multiples in emerging markets in Asia and developed markets is going to close. I guess the second point is, and I don't want to spend too much time on the US election this morning, but there are a lot of developed markets that are acting like emerging markets. And there are a lot of emerging markets in Asia that are acting like sort of grown-up developed market countries. So if you look at sort of some of the things that are happening in the US, where there's civil unrest on the streets, there's a potentially disputed election on the cards, there's highly politicized Supreme Court situations, there's very high debt and deficits, there's a currency that's in free fall, there's a pandemic that's out of control. I've been doing emerging markets for 20 years, and if that kind of stuff happened in an emerging market, that market would be down 30-40%. People would just absolutely go after that market for those kind of events. And that the US is at all-time high. And even if you look at Brexit and what's going on in Europe, this is not a good situation. These markets are still trading at high multiples. Whereas if you look at in Asia, countries like Korea and Taiwan, even to a large extent China, they're acting like developed market countries, but they are still trading at emerging market levels. So I think that once people, you can see that chart on the left-hand side, once investors realize that those risks that are typically assigned to DM and EM are actually all muddied up now, I think that's another very strong case for emerging markets, particularly the higher income countries in Asia having a big multiple re-rating. So medium and long-term view is EM is much better than DM. I won't spend too long on this. I just want to remind people that we are a high growth fund. We only invest in high growth companies, and we have over 56% of the portfolios in tech right now. A lot of these are in the large cap tech names in Asia. Our 4 largest positions are Alibaba, Tencent, TSMC, and Samsung. And these stocks have obviously done very well during the COVID period, and they have been contributors to both absolute and relative returns. So COVID, just a bit of a highlight on how we've been looking at COVID and how we continue to look at this going forward. Right at the end of January, when COVID happened in China, and the rest of the world, people didn't start worrying about it until February, March. But in China, it hit at the end of January. We took the view that it's going to be first in, first out, and that countries that were successful in flattening the curve would come out first, and therefore their economies would come out first. So based on this, we have had a bias towards North Asia for many months now, and so China is by far the biggest allocation, and then Korea and Taiwan are also bigger allocations than they have been in the past. On the flip side, ASEAN, I have hardly any stocks in ASEAN at all, besides the Singapore Bank, nothing in Thailand, nothing in Indonesia, nothing in Malaysia, nothing in Philippines. So ASEAN is further down on the pecking order. In terms of second waves, earlier in the presentation, someone was mentioning about Europe. We are watching second waves in Europe quite closely, but in Asia, particularly in China and the Northern Asian countries, they have been very successful in maintaining containing second waves. So we're positive about the outlook there. Okay, so U.S.-China relations is something where we're getting a lot of questions. And my view is that the U.S. is in hegemonic decline and China is in ascendancy, and that is something that's going to play out over the next 10, 20 years. I expect for the rest of my investing life, that is the base case. And so I know there's a lot of investors that are hoping that Biden gets in and then everything goes back to normal. I think the new normal is actually tension between the US and China. And as investors in those regions, people just have to get used to it. That said, I think if there is a Biden administration, at least policy will be more predictable. And it won't be sort of Twitter diplomacy where we wake up in the morning and you have 27 tweets from Trump and 18 of them are anti-China. So that as an investor will be a nice change. But I don't think that Biden is going to be soft on China. And anti-China sentiment is sort of one of the things that both Democrats and Republicans can agree on. But I also don't think that it's going to be focused on trade if Biden gets in. We have these 4 flashpoints that we've been tracking in U.S.-China relations over the last few years. And for the first 2 years of the Trump administration, it was all about trade. And more recently, you've seen it become about tech, whether that's Huawei or banning WeChat or TikTok is very much focused on technology. Capital markets is also important because, as I'm sure you know, there's a move to sort of delist or go after the Chinese ADRs. And then Hong Kong and the Taiwan is also in that category, sort of more on the foreign policy aspect is something that we're watching. So that said, I think China is the strongest economy in the world right now. Third quarter GDP growth was over 4%. Expectations for 2021 are 8% growth. So this is much better than you're getting anywhere else in the world. I recently increased my allocation to China. And lastly, I'll just comment a little bit on how we're positioned. As I mentioned before, we have a strong bias for North Asia, so Hong Kong, Korea, and Taiwan. India is an interesting case. India was actually very unsuccessful at flattening the curve, and as some of you know, it's the second highest number of COVID cases in the world. That said, the Indian market has sort of shrugged that off, and it has had a very strong few months. So we are just equal weight India, and then significantly underweight ASEAN. In terms of sector exposure, tech is by far our largest sector, followed by consumer and then financials, and the other sectors are very minor. We are a concentrated fund. 60% of the portfolio is in the top 10 stocks right now. And as you can see there, similar to what I commented before, there's a very strong bias towards tech, particularly in North Asia.